Hello and welcome to IG's Trading the Markets podcast. I'm Victoria Scholar. The US dollar made an abrupt turnaround in March, ending its bull run that lasted more than 2 years. Since the peak in the first quarter, the dollar basket has shed more than 10% of its value, and analysts now appear divided. Is this the start of a bear market that could last several years, or are the worries about the US dollar overblown? With me to discuss is Chris Vecchio from DailyFX, who joins us from New York. Chris, great to chat to you. First and foremost, let's start with the turnaround in March. What prompted that rather dramatic reversal?
Hi, Victoria. Thanks so much for having me. When we talk about the US dollar, it really is a story about how the United States has mismanaged the coronavirus pandemic. In the world of FX, everything is relative. I mean, literally, the currency pairs are ratios: euro to dollar, pound to dollar, dollar to yen. And so, relatively speaking, the US handled the coronavirus pandemic worse than everyone else. And so, while Europe had stable fiscal policy and enhanced fiscal policy, moving towards a solution with public health being the focal point of the response, the United States has not done that. The economy has suffered more as a result, and therefore the recovery is going to take longer. A longer recovery necessitates more easing by the Federal Reserve, more expansionary fiscal efforts by government authorities. And these are things that on a relative basis, when Europe is not dealing with them, when Europe's monetary policy is not as loose as the United States, when it's not needing to spend as much money at the government level, it's going to be a more stable currency. And so the United States' lackluster response to the coronavirus pandemic, coupled with the necessity for loose monetary and fiscal policy to make up for the bad response to the pandemic, has really been the albatross around the dollar's neck.
You were talking about the recovery. What do the declines in the US dollar mean for the domestic economy? Because obviously, on the one hand, it makes imports more expensive, but also it makes exports more attractive. I mean, what do you think is the likelihood of the net effect on US GDP?
I think at this point in time, given everything that we've seen, that's a negligible footnote. At this point in time, we've had a lot of conversation about a V-shaped recovery, the difference between what the dollar could contribute to a V-shaped recovery or not. In this part of the game, so to speak, is so insignificant. It will not be the difference between us saying, but for that US dollar, we would have had a V-shaped recovery. The fact of the matter is that the economy is not showing signs of rebounding and returning to pre-pandemic growth trend with any sense of urgency. High-frequency data indicators such as initial jobless claims, and then drilling down to even being a little bit more nuanced, using things like open table reservations year over year or CBRE office swipes at the turnstiles in their buildings in Manhattan, or Google Analytics foot traffic data, search requests on maps. These all suggest that the economy stalled out in July and has been struggling to regain its footing as we move through this third quarter. As far as I'm concerned right now, the dollar and the pandemic go hand in hand. If the pandemic gets under control in the United States, that's when we'll see the dollar start to have its prospects liven up. But even then, it's going to be a difficult slog because of this relative nature of the world of FX.
So analysts appear to be divided when it comes to the recent declines in the dollar. HSBC, for example, last month saying that the weakness is not likely to turn into a long-term secular bear market. Citigroup, on the other hand, writing that this bear market could last 5 to even 10 years. Where do you stand?
I think I fall closer to the Citibank side of things, if you will, only because the underlying premise of what's going on with the dollar is that, we talk about loose monetary, loose fiscal policy. What we're really getting at here is a conversation about real yields. In the world of FX, everything being relative, currencies don't have an intrinsic value like a cash flow or a dividend that you can peg a PE ratio to. So we look at differences between inflation rates and interest rates in forward-looking measures to determine what the value of a currency is. And so to this point, right now, I think that an environment defined by loose fiscal policy and needed loose monetary policy to combat what has been a dramatic drop down in aggregate demand out of the U.S., unforeseen since the Great Depression. This will leave the U.S. dollar in a position for a number of years where it has negative real yields, which is in turn why I'm so bullish on precious metals, why I think that equities still have a long way to go ahead of them, why I think that investments like real estate are making a lot of sense for people. Negative real yield environments tend to cater to weak local currency, stronger precious metals, stronger local stock market. in effect because of a lack of better options.
So this month, Russia and China said that they're joining forces to cut their dependence on the US dollar. I mean, with the rise of China challenging the US as the world's largest economy, along with alternatives to traditional fiat currencies like cryptocurrencies, I mean, can you see the dollar maintaining its status as the world's global reserve currency, particularly in light of what you just said, the fact that we could be in more of a secular, long-term bear market, and that's creating opportunities elsewhere?
So would the dollar lose its reserve status? That's certainly a possibility. The problem is, what is the alternative? And given everything that's going on in China right now, if it's from the way they've treated Hong Kong to the Uyghur camp in the West, I don't think that anyone is too keen on using the Chinese yuan as their focal point of stability in the world of global finance. It's also difficult to peg that to another major currency like the pound or the euro or the Japanese yen, simply by lack of outstanding FX reserves available to other central banks. The world is more or less stuck with the US dollar right now. These other central banks, these other countries can take moves to remove their dollar dependency, and certainly getting away from oil-based transactions behind the buck, what's known as the petrodollar status of the US dollar. That would help other countries have an argument to say that we don't need to use the US dollar. But for now, as long as oil contracts globally are settled in the greenback, and until China starts operating with other major economies on a basis to use the yuan, we're talking about the Eurozone, we're talking about Canada, we're talking about the Western nations like Australia, New Zealand, the world's developed global economies. Until those countries start using the yuan, it's not going to displace the dollar. It needs trust, it needs allies. I just don't see those things happening at this stage of the game. But what other options are there? That really is the point here. Could we go to the SDR, the special drawing rights basket that the IMF runs? Possibly, but why would the United States want to give up that control? This opens up a whole other host of issues. I do think this is an interesting question, but between Russia and China, yes, China is the world's largest, becoming the world's largest economy, but Russia is an economy the size of Italy's with nuclear weapons. It's basically Europe's gas station. China needs to do something with a country like Great Britain or Australia or Canada and move away from US dollar transactions for me to feel that we're actually in a significant risk of seeing the dollar displaced. Finally, I do want to say one more point about this. One of the big things that undergirds the US dollar's reserve status is the percent of global GDP that comes out of its nation and its allies nations. And so to this point, US and its Western European allies and allies that are trading partners of the United States around the world, they retain about 53% share of global GDP. This is down from 70% in the immediate aftermath of World War II. And so as the globe is moving more away from the West and more of economic activity is done in the Southern Hemisphere and in Asia, there is a stronger reason to say that the dollar should not be the focal point. So this is a conversation that will not go away. Even if it survives the pandemic, we will be at a point in time 5-10 years from now where there are more people asking the question, should the dollar still be the world's reserve currency? And so we'll talk about this in a month and in a year and in 10 years. This is not going away anytime soon.
I wanted to get your insights into the relationship between the US dollar and risk at the moment, because the picture in terms of risk on and risk off is quite mixed. I mean, we're seeing risk ons for gains for US equities like the S&P and the Nasdaq Composite hitting all-time highs, yet we're also simultaneously seeing that flight to safety trade with gold in a bull market. From what you're saying, it sounds as though it's more of a risk-off asset in the sense that it's highly correlated to the progress with the pandemic. But what's your kind of overall take as to where you stand when we think about risk appetite?
The dollar's role in all of this has certainly evolved in recent months. If you recall back to the start of the year, the Fed actually had higher interest rates than a number of other currencies that we would call the commodity currencies, for example, because of their relationship to base metals, to industrial growth. But now all of a sudden that's not there. The interest rate edge that those currencies had over the dollar has disappeared, or excuse me, that the dollar had over those currencies had disappeared. There's no longer that carry trade component that has driven the bullish narrative behind the greenback. You know, this is a really interesting situation for the dollar. Is it a risk on or risk off currency? It's wholly idiosyncratic to what's going on in the market that day. You know, do we have higher inflation data? If so, yes. Is that a sign that there's stronger economic growth coming out of the US? If that's the case, then US yields are rising, and that tends to be good for the dollar. And you know what? if U.S. economic growth is coming back, that's actually good for stocks too, because now we have higher corporate earnings coming with a backdrop of loose monetary and loose fiscal policy. And if we do have bad data emerge, well, then there's the excuse that, well, we're in the middle of a pandemic, but we still have more stimulus coming. So people tend to go into stocks anyhow. The dollar's role in all this is completely contingent upon what we're seeing each and every day. To peg it down to a risk on or risk off currency right now, I think would be irresponsible because its role is still evolving.
And very finally, I just wanted to look ahead to the US election, clearly a very important part of the political and economic calendar in terms of the months ahead in November. I mean, what would a Trump victory or even a Biden victory mean for the US dollar? Do you think Republicans or the Democrats are more favorable to the outcome for the greenback?
I think it wholly depends on how we see the congressional races shape out, right? As we know from the last 2 years under Donald Trump, as we know from basically the entire Obama presidency, when one party controls the White House and another has separate control of one of the branches of government, one of the houses in particular in Congress, then not much gets done. So in the event that Joe Biden were to win the presidency and the Democrats control the White House, but Republicans still manage to maintain control of the Senate, we more or less see the same things that are going on today continue into the future. There's really not much opportunity for the president to get what he wants done because the Republican Senate will have say at the end of the day as well. This is totally contingent upon whether or not we see the House, Senate, and presidency all aligned with one party. Given polls, what we're seeing is it looks like the most likely outcome is that Democrats win the presidency, they retain the House, and they right now are likely to win the Senate. And in the event that Joe Biden and Democrats were to sweep across the board, that would probably actually be bad for the dollar because they would spend more money on the fiscal side. That would increase deficits. That would increase the supply of U.S. treasuries out there, with the Federal Reserve continuing to keep rates low and promising to do so through 2022. This would mean that real interest rates would head deeper into negative territory faster than they have right now under the Trump administration. I do think that would be an environment actually very good for stocks, still good for precious metals like gold and silver, good for real estate. On the other hand, in the event that Trump does win, it is looking like he would do so and come away with a mixed Congress where Democrats retain control of the House and perhaps Republicans retain control of the Senate. And that means the policies that we're seeing in place today, the culture and climate that we're seeing today, that doesn't change. And the environment that has led to the dollar that has suffered on this lack of uncertainty, this lack of promise to commitment to solve the virus, those things would still hamper the greenback. But the mechanism by which the dollar is getting hurt changes ever so slightly. It becomes a lackadaisical response to a global health crisis and the ongoing long tail of stimulus that's required to pull the U.S. out of the depths of its depression versus a more immediate, sustainable push towards stimulus that, while increasing deficits greatly in the short term, hurts the dollar even more, could actually lead to a recovery emerging sooner than later. So Donald Trump wins. It's likely that Republicans have a mixed Congress in their back pocket like they have right now. Makes it difficult to change policy whatsoever. If Biden wins, it would appear that the polls are suggesting that it would occur with a sweep in House and the Senate. And that would mean much more government spending at the federal level. That means a looser monetary, looser fiscal policy. It means more negative real yields for years to come.
So just to be clear, thinking about the moves in the dollar that we're seeing right now, which is with Trump with a mixed Congress, you're saying that either way, it's more likely that the dollar's moving lower.
Unless the Federal Reserve announces an abrupt turnaround where they declare that they are no longer going to keep rates low through 2022, I myself think that they are operating under the guise of a pseudo yield curve control. They have an explicit target for the short-term rate. They've given us a time horizon out into the future for how long they want to keep those rates low. They are telling us that they are controlling the yield curve. And in this environment, regardless of what happens at the presidential level, even at the congressional level, we still have an environment defined by the Fed tethering rates low. And so to get the dollar away from that narrative, especially in this world of relativity where, the UK is growing faster than the US right now, or Europe or Canada, where all these other developed countries are performing better than the United States in both how they've handled the pandemic and how their economies have ensued in the recovery, the dollar is in a rough spot. It's really difficult to pitch a bullish case for it. So if we do see the dollar rally from here, it's going to mean that the Federal Reserve has backtracked on its intent to keep rates low for so long. And that would cause a whole host of other issues for the bond market and for the stock market And I don't think the Fed can afford that misstep in its credibility. So I do think that a weak dollar is here to stay.
All right, that's all we have time for in IG's Trading the Markets podcast. Thank you so much to my guest, Chris Vecchio from DailyFX. I'm Victoria Scholar, and we'll see you next week. For more videos like these, subscribe to our YouTube channel, IG UK, and make sure to follow us on Twitter. We're at IGTV.